Hello, hello, hello. Welcome to Now Stock Trades. I'm sorry about that. Hope everyone's doing well. And yeah, so just to kind of give you guys an update, I've been really busy recently. And sadly, I won't be able to do the lives for Clover. So we're going to do it more internally on our stock terminal and just talk about it through there. But I will create a summary when I have some time. But in this video, usually we don't really go start a video this early, but just it's been really busy. Good morning to you, my friend. So in this video, what we're going to be doing is just kind of talking about the macro, what's going on with Clover, Humana, United Healthcare, and also Alignment Healthcare, which has recently shot up 26% the past 5 days. Literally, honestly, the past day, to be honest. But overall, it shot up. So we're going to be talking about that, how they beat revenue estimates, but did not beat earnings estimates. But why are they growing, et cetera, et cetera. So we have their information here, talk more about Clove and some remarks regarding the CFO and his recent posts. So that's kind of on the docket here. Okay. So I'm going to go run through these top 10 things. These are the things that I'm considering. I think maybe 2 or 3 of them are repetitive, but that just shows you the importance of them. So number one, inflation concerns. Market, if you asked them last week, they're worried about inflation, right? The outlook was negative. Inflation can erode purchasing power, impact earnings, affecting investor sentiment negatively. Like we already know that, right? That's been the talk for the past 2 years, right? Number two, dovish monetary policy. So the slowing in balance sheet runoff, if you don't recall, we had an FOMC meeting on Wednesday, and they were basically, the market, Wall Street knew they were going to do this. So this actually is the outlook is positive, especially when you slow that balance sheet off, right? So this suggests less aggressive approach by Federal Reserve, which typically supports market growth. Okay, so that's dovish. Or number three, inflation optimism, confidence that inflation is falling. So the outlook actually is positive, as decreasing inflation could mean sustained purchasing power and potentially lower interest rates. And we're going to be talking about this inflation optimism soon, because in the beginning, when we had the sticky inflation, a lot of people that don't, the bears were saying, oh, this is going to be sticky. That means that, it's going to go ahead and there's going to be a reoccurrence in inflation. Well, I'm not in that camp. I don't believe in that, right? I don't agree with that. So number four, stable economic view. So no signs of stagflation, no rate hikes planned. So this obviously is a positive, right? So indicating stable economic conditions without dual threat of stagflation and inflation, which supports market stability. In fact, you can directly cite Jerome Powell, federal chairman, the Federal Reserve, FOMC, states that, we don't believe that there's stagflation involved. You can't have growth in stagflation. So there's about 3% growth. So overall, the little discussions of stagflation is baloney. Number five, mixed employment data. So job growth missed expectations, unemployment rose. So this actually is really good. So the outlook is mixed, as a week of job growth could signal the economy cooling down. But yet, here's the thing: this is where it's actually bullish. Now, many folks are like saying, "Oh, why? A cheap, a bad jobs market is supposed to be bad." No, guys, right? So it's actually good because it prevents the Fed from tightening rates. So the whole notion of tightening interest rates this year is out the window. Which is why, if you look at the market on Friday, I'm sure this hasn't been updated yet. Markets are closed. They're probably going to open up on Sunday on the futures earlier on in the evening, but you could see the market reacted really well, guys, right? The market just ballooned, right, from this excitement, right? And this is true, right? And this sets up for a great next week. Before, everyone had the inclination that May was just a very terrible opportunity to go into stocks. May will be, but I think now May is presenting itself as a buy the dip opportunity. And anyone who took advantage of it in the past couple of weeks has been rewarded handsomely. Like, again, I don't know, what was Clover a couple days ago? Clover was around 63 cents, and then it rose up 10% just from that, right? And I think it wasn't it lower week before, 62 cents. Yeah, you're up 12%. So again, it's the narrative is presenting itself as the buy the dip opportunity. But let's go back. So again, with the unemployment, the expectation was 3.8. It was actually 3.9. I kind of summarized this in a very easy way. Remove the numbers, just giving you the take home message. Luckily in life, things are binary or trinary. It's either good, bad, or nothing, right? So So that's kind of like how I kind of broke this down for you guys. Okay, so high unemployment costs, low productivity, market worry, right? So the outlook is negative, suggests economic efficiency. So this is kind of a mixed outlook here, right? If things are expensive, people that have a lot of employees are going to have essentially, it's going to be really expensive, right? And so you're going to start to see some deleveraging from employers, which you have started to see with Tesla, et cetera, right? As they go on to the next phase of their cycle, right? You also have Apple buying a lot of their stock, which I think will cause a resurfacing within technology stocks, and I think they will rebound shortly after this, right? And I think this is they're buying it right before their AI push that they're going to integrate into their iPhones. I think because they're about to go into AI because they remember they removed themselves from the car manufacturing type of the business here. So number 7 is Powell was uneasy with high rates, right? So rate cut is pretty likely, right? This obviously the outlook is positive here. It suggests that barring conditions are soon going to be a lot better. And I want to pause here, right? I'm going to put a dash here, right? I'm going to pause here and just talk to you guys for a sec. So like, you know, so we called out Energy Transfer a few months ago, and it's been doing really well, right? It's up 14% this year, and again, we called it out when it was 9%. The thing is, I've been in, I've known Energy Transfer since it was like $4, $5 when it got hit hard in the pandemic. It was like $3.90 or something like that. I'm talking about right here when it was really low. The intraday, it says $4 was actually lower. The intraday was a lot lower. And overall, I mean, I could see that. Yeah, I would love to place some winnings from Clover into this behemoth of a great dividend stock, as well as other LP companies that I looked at. And but overall, the point that I'm trying to make here is, okay, so let's say Clover hits its intrinsic value this year. Okay, so I don't think it will, but let's just say it does. What are you going to do? Right, you're going to buy a home? Not really, because the interest rates are too high, right? Are you going to buy other stocks that some of them are pretty high right now? Not really, right? So I guess what I'm trying to tell you guys is, I'm happy with kind of how things are playing out right now. I actually never thought I would ever see these prices. And again, this is the opportunity of the market. Just like how people were crying over Meta, Jim Cramer, right? When Meta was around $100, it was a great opportunity, right? In fact, it recently did drop, but I think it recently had a drop, and now it's on its recovery pathway. But when I tell you when Meta dropped, people were sad. It was around here when it was $90. People were very upset when it dropped like 70%. But then people that bought, look at that, they're up 4x, right? Almost 5x, right? When it was at its peak, right? So the point that I'm saying is, a lot of people are saying, "Oh, I want my money now. I want my money now." Okay, well, okay. Imagine, okay, here's your bag of money. What are you going to do with it? What are you going to honestly do with it? Right? So again, sometimes people's chemistry in their brain is different. The type of advocation that I'd like to do is, I'm a long-term holder, right? If this company shows promise after it hits its intrinsic value, then most likely, it's going to be a hold, because if this thing does end up becoming a leader in PPO in the overall Medicare Advantage market, then yeah, right? And I'll talk about that a little bit in the video here. So weak April jobs report, this generates a rate cut expectation. Like now, I like if you ask Wall Street now, they're all saying anywhere between 1 rate cut, 2 rate cut, 3 rate cut, and 4 rate cuts. I didn't see no more than 4, I think. But overall, rate cuts are on the table now. Okay. So let's just say if we get 4 rate cuts, that's dovish. 3 rate cuts, what do you think? Dovish or hawkish? That's dovish. 2 rate cuts, dovish or hawkish? That's dovish. 1 rate cut, dovish or hawkish? That's dovish. 0 rate cuts, dovish or hawkish? That's actually dovish. How about rate hikes? Yeah, that's hawkish. So the consensus of rate hikes, that's not in the market now. Hence why the market's kind of like, like rallying, right? So I do believe there's going to be a cut, and let's not get it twisted. If the Federal Reserve cuts interest rates, that's regardless how many times this year, that's hawkish. I'm sorry. Hello, that's dovish. That's good, right? That's good. Okay, sorry for confusing you there. So after that, the S&P recovered. Essentially is recovering. and we saw a pretty good positive gain on the 3rd of May. So now let's go ahead and talk about Peter here, right? So he's the new CFO. If you don't recall, we got a good welcome. I don't even know we got that for Scott, honestly, right? We got a nice welcome here, and this good morning. Oh, hey, how are you doing? Look at that. So we got a good welcome here regarding uh, Clover Health here. So on Wall Street. So this is pretty good. Almost think of it like a rebirth almost, right? So got pretty much of a good signal here. And I don't know what this thing here is on the left. Dead Boy Detective. I think maybe this is, oh yeah, it's a Netflix series. So that's good advertisement, I guess. And got some bring them home here, hopefully, and yeah, so it looks pretty good here on what Peter, but I have some criticisms here, okay? So I do love the focus, and I do love, it's very centric. He's a strategic leader. But when Clover gets bigger, I would love just to see Peter, CFO at Clover Health, done, right? All this other stuff here, hit the delete sign, right? But it's okay. Right now he's just trying, it's trying to show what he's done, right? He's done a lot of supply chain, which is important for risk management, ex Yahoo, ex GE, ex EY, business trans, it's great. But in the future, I would love to see CFO at Clover Health. Just clean. Okay. But that's a small criticism there. He just started. So hopefully he does make that change. Because you could see all of his stuff here, down here, people that are interested, right? But he does say something that's pretty interesting here regarding the 5 mistakes CFOs can avoid. Okay. And this falls in line to what Scott made as a mistake, I think, in terms of communication to shareholders. So ignoring new tech, right? So keep an eye out for gaps in financial processes and keep an eye out for specific tech solutions to fill in these gaps. Well, we know the Clover's MCR is around 79, 80%. So that's actually pretty good MCR, right? In comparison to the medical loss ratios for other companies, including Alignment Healthcare, which we'll talk about, which has a medical benefit ratio, same thing, medical loss ratio of 90%, specifically 90.9%. Okay. Number 2 here, siloed strategic planning. So planning cross-functionality, best way to optimize holistic growth and innovation. So this actually goes in line with Vivek was trying to say. How, like, when you're in a hospital system or when you're in an insurance company, the insurance companies have a siloed process where the cardiologists only know what they're doing and the nephrologist are the only knows what they're doing, and the family doctor is trying to basically conglomerate all this information. And there's just a lot of silo. It's just everyone's siloed in different areas, and this is the problem with healthcare. In fact, I was just on a rotation, and I heard some unprofessional comments. Where people were blaming anesthesia, like, oh, it's anesthesia's fault, and they said some cursory words for anesthesia. It shows you the culture of medicine. Intrinsically, when you have a lot of Type A people, you will get some almost like a high school. It's just inherent to just how evolution works. People like to stride with their group, right? Because it just makes them feel safer. But this doesn't benefit this doesn't benefit the patient. Having a siloed system doesn't benefit the patient at all. Collaborative work does. So here, number 4 here, overlook risk management. Yes, very good. Overseen on like liabilities that can happen in the future. Great. That's on his radar, as it should be. Okay. Now, this is a big one for Clover Health investors. Very huge, okay? This is why I wanted to show you this, is because of this. Limited stakeholder communication. Align, align, align. That's so true. You want to align yourself with the shareholders, right? Because they're ultimately the ones that own the business, right? So insufficient communication with stakeholders hinders progress towards business goals, okay? So I expect that this new CFO is going to be very good at communicating with investors, okay? Because this is going to be very crucial for the growth of this company, okay? Skipping investments and talent development. Yeah, this is okay. And all this other stuff, okay? So now let's go ahead and talk about Clove, okay? So Clove right now is down 27.6% year to date. Humane is down 31.81% year to date. And United Healthcare, it's down 8.69% year to date, okay? And then Alignment Healthcare is going ahead and it's down 21.85% year to date. Now, again, remember, Alignment was actually down like in the 40%, but just recently it went up 26%. Okay, so it's doing so why? Why? What happened? Like, what's going on? Like, what happened to Alignment, right? And if you don't recall, I think I did an intrinsic value calculation on Alignment Healthcare, and I believe I got an intrinsic value of anywhere between I think $9 to $20. I think. I have to redo the video. I have to like relook at the video when I punched in the numbers. But yeah. So Wall Street, I think their expectations are around like around $10. I think. Just go in the stock terminal and kind of push it in there, and then you guys will be able to see it. But overall, Humana is last right now. Humana is 31%. Clover is 27%. United, with its behemoth of a company, 8.69%. And then here we have Alignment. So let's go shift to Alignment right now. So they went ahead and they grew their business approximately 40% plus on the revenue side year to date. Now, the biggest part here is the Medicare Advantage membership growth is 50.5%. Guys, they are killing it in the Medicare Advantage. But here's the issue. Look at the medical benefit ratio. It's 90%. So yes, they're growing 50%. What is it? 50.5% on the Medicare Advantage. But ultimately, look at the benefit ratio, right? It is 90%. Now, again, I'm sure throughout time, they have their own systems to bring that down. But ultimately, that's in comparison to Clover at 79, 80, 81%. That's pretty significant. That's 1,000 basis points significance, which if you don't recall from 2 years ago, they said that the Clover Assistant helps with that. Okay. So that's kind of where I'm at right now. So for earnings, what am I expecting? I'm expecting EBITDA profitability, which means net income negativity. Don't let that confuse you. And still in my books is going to be net income negative. I want to look at free cash flow. Okay. Free cash flow to me is king. Okay. I want that free cash flow hopefully to get near positivity. Okay. Where the members that are in the 80% MCR range are going to be offsetting the profits that come out of those members are going to be offsetting the growth of Clover for future tense. And then there's another area of Clover that they've been really quiet on. Again, align. You got to align with the shareholders. Okay. Which is the Clover Assistant, which the whole thing regarding the SaaS-like businesses. You already know that SaaS companies, they tend to be evaluated at a higher revenue multiple price to sales of approximately anywhere between 5 to 7x. And if you're Palantir, it's anywhere between maybe, I don't know, like 15 to 30x, right? So we know that this is not just talk, smoke out of someone's behind. This is real, right? They went ahead and hired a VP of SaaS. So there's that. We know that this particular CFO is really good with SaaS, his experience in healthcare. So we're, hopefully we start to see that. But here's the thing. Before I see that, what I would like to see is Clover increasing in their star ratings. Now, again, Andrew Torrey touched on this regarding how when they were growing really rapidly with ACO and everything, it was very hard with the aberrations to statistically map out the mathematical sequences of what CMS rates what the star ratings are. Now that they're not growing so much, the ratings are going to be a lot easier to anticipate. They can really take care of their people to up their reputation. Okay. So overall, if you were to just kind of back away right now and take the overall perspective of Clover and just look at it from the outside, they're going to be like, investors that don't know much about Clover, or even, again, people that have degrees. Again, degrees don't matter, nothing. Okay. It's just humans are humans, right? They're going to say, oh, this is one of Chamath's SPACs. It's a SPAC surge. It was a short squeeze candidate. It's a Wall Street bet stock, and it has no future, and there's no business model. Okay. And, whenever you get miscalculations like this, because the MCR is good, just from the Medicare Advantage side, if they focus on that right there is a profitable business. Okay. They have to prove themselves with the Clover Assistant, right? That is something they have to prove, getting something from A to B, right? But overall, that's the consensus that Wall Street has right now. And if you just ask Joe Schmo, who's looked at Clover before, okay, who hasn't really dived into Clover, who hasn't really dived into Alignment Healthcare and all the other ones. Okay, so overall, that's kind of the image. And if you go ahead and take a look at, let's say, for example, Enphase, back then, when I say back then, I mean like 2017. Let me see if I can find it here. Yeah, whoop, where'd it go? Look at that. Back then, Enphase was 72 pennies. It was where'd it go? It was 72 pennies back then. 72 pennies. Okay, and now look at Clover. Clover is what? 70 pennies. Okay. Back then it was net. It was net. They just diluted shareholders back then. They diluted. I mean, guys, listen. The stock went down 90%. The stock dropped 90%. Okay, they diluted the hell out of their investors, but all of a sudden they were up to that growth. And for the people that sold, well, they sold at a 90% loss. And the people that bought those shares from the people that did not have conviction. I'm trying to find the 70 cents. There it is. Or it was 72 cents, I think, but whatever. This will work. This is the growth that they saw, 43,000%. Okay, it's not 43x. Was it? No, 43,000%, right? Because I think 100% is 1x, 1,000 is 10x, 4,000 is 40x, 10,000 is 100x. This is 400x your investment. Okay, so you put in $1 and you get $400 out. Okay, all right. So, and obviously it dropped, right? It's still 14,000x. But again, if you would have done the intrinsic value, if you don't recall, I said Enphase is a sell. I think at 250, 275. Then people were like, "No, man, you're messed up. You missed out on a 40% gain." I don't care, right? It was a sell, right? And people that held, well, okay, you just lost 66%, right? So again, the intrinsic values work when the market makes sense. When they don't work, that's when the opportunity comes. Okay. So that's all I have for you guys in regards to this. I like to see this. It's great, to see this like, oh, Clover Health. Oh, wow. They're still around. Oh, wow. They just appointed the CFO. Oh, crap. Oh, wow. They're 70 cents. What are they doing? Again, they're a maturing company. Okay. I believe now the second half of this decade is going to be seen differently by Clover. I think 2026, 2027, 2028, Clover is going to basically, it is going to be that company. Okay. It's going to be that company. Everyone's going to be like writing articles and saying, oh, if you invested Clover when it was at 2024 levels, you would have made X, Y, and Z. Again, we know these games. Okay. So I think it's going to be great. And it's a long-term hold, right? It's a long-term hold. So let me go ahead and go through the questions here. It was funny watching 2024 price predictions. Your model said bankruptcy case for Clover 60 cents. Haha, possibly the most mismatched value stock in the decade. Exactly. The bankruptcy case was 60 cents. I mean, this company was literally at its bankrupt. I mean, it was 60 cents not too while ago, right? Here, let me see. Like last week, was it? It's like 60 cents. It went to 61 cents here. See? 61 cents. It was literally selling at bankruptcy. It was literally selling at book value. Like if the company were to be liquidated today. I mean, guys, listen, Alignment Healthcare, their book value, I think is like 80 cents or 90 cents, but they're trading 6x of freaking book value. Okay. I mean, if we're trading the same thing right now as, if we were to do that, Clover would be $3.54. Okay. So we're like selling at bankruptcy case. And, if it's true that this is bankrupt, then why is all institutions should be selling right now, but why is Renaissance Technology doubling down? Why is JP Morgan back into play? Why are the institutional investors buying these penny stocks? Now, personally, I would like this to be above a penny, but again, that time will come, right? Yeah, and there's been people here that, that got it around 8 and now averaging 160. So again, a lot of the OGs now averages are in anywhere between 150 to 220, I would say, right? With some in the $3 ranges, right? And then people coming on the way down. But again, this is where the opportunity is. I mean, look, there's a lot of examples of when end phase, the stock was like, it's hard to see this because it looks so small, but this was like $16, guys. $16 stock going down $15 is a 90% loss. It was more. It's like 95% decrease. And we're talking like 72 pennies. Okay. So, stuff like this happens. Okay. And now everybody is talking about Enphase. It's a $15 billion company and everyone's talking about it. Okay. What the hell is a $15 billion company in comparison to Apple? It's a $3 trillion. Okay. I'm not saying like everybody, but so overall, I am very dovish for the future. I believe inflation's falling down. I believe the analysis that I made for you guys here is pretty succinct to what the market outlook is going to be. And I think, if you were to kind of remove inflation and just look at the stock price for the S&P 500 and go from 2010 to 2020, just add a 2 between the 1, right? So instead of 2010, put 2020. Instead of 2012, say 2022. Instead of 2015, put 2025, right? I think the latter half of the 2020s is going to be really well for this company, right? And all the other companies, right? So yeah, I mean, I definitely believe in it. It's I would what I've hoped for it to reach faster, the proof, not the price target, but just the ultimately proof of concept. Yeah, of course. No, of course. I would be lying to you if I didn't say that, right? But I'm hoping to see proof of concept 2026, 2025. I just want those that star rating going backwards, man. It's like, 2 steps forward and 1 step backwards for this company. So again, there's a lot of changes right now with new CFO and the CFO leaving. And, and that CFO was honestly a risk management CFO. He kind of basically cut the fat off of the company. But that's pretty much his expertise, is pretty much just risk management. And I hope now Andrew is realizing that, hey, this is his baby. Clover is his baby. This is his primetime NBO show. That because his other company was bought out by Google. He wasn't on Wall Street. He's on Wall Street now. It's a lot of pressure to run this company, especially this is not some tech company. You're dealing with people's lives here. Trust me. Like I'm having problems, taking care of patients in the sick queue, trying to learn their diseases. Imagine 80,000 patients. And again, they're not all sick queue patients, right? God forbid, but again, patients are complicated. They have a lot of chronic diseases, right? So I went ahead and I did an analysis on this, I think in the prior videos, but overall we could do it again. Sorry for yawning here. Let me open up the intrinsic value here. One moment. So we can go ahead and do that, but we can just go to home real quick and just go to the one with the price to sales, because I think that's going to be a really good one, right? So we could do a linear progression analysis here, and then we can open this up. Okay. And we could kind of just grow this out here. All right. So Clover's revenue is 1.23. Their growth rate right now, let's say 5%. Let's say 5%. Shares outstanding, let's say 500 for right now. 500. And let's say that just generic price of sales of an insurance company is 0.5. So Clover should be trading anywhere between 92 cents to $1.54. So you're saying 2026. So, that's like 6 minus 4. That's 2 years. So in 2 years, Clover should be anywhere between $1 to $1.70, right? And this is just a 5% growth rate. This is just the bare bottom bones. We should be increasing to anywhere $1 to $1.70. That's not in line with what Andrew Torrey was saying, how they're going to activate the growth machine. And also the evaluation for Clover, I think, is not going to be a price to sales of 0.5. I think they're going to be a price to sales of 2.5, because that's how they were when the market was equilibrized, not at its high peak, but at its standard peak regarding the Medicare Advantage companies, the new ones, right? So, well, let's say They grow, and an 18% growth rate is a pretty respectful growth rate. That's not too high and not too low. So that means Clover, again, today, 92 cents to $1.50, but in 2 years, it should be anywhere between $1.28 to $2.14. Okay. Now, if we go ahead and do a price to sales of 2.5, which is what I think is going to be at, that then it changes the game, right? Now we're looking at anywhere between $4 to $7, and in 2 years from now, we're looking at anywhere between, I don't know, $6 to $10, right? So overall, if we were to just say drop this down to 0.5 and say, I want to go into the, let's go 10 years into the future. This company is either going to be, if they're going to grow at 18%, but they're just going to be labeled out as an insurance company in terms of the price to sales of 0.5, then I would say for every dollar they make, it adds only 50% of market, it takes half of that to the market cap. It's anywhere between $4 to $8. But if we go to 2.5, then we're looking at, like I said, from the original intrinsic value I made from the beginning of times of Clover, we're looking at anywhere between $24 to $40, right? But this is like, we're talking 2034, right? We're talking 10 years from now, right? Again, this is 2032, but I just have to update it. Just kind of, just replace the numbers here, right? Year 1, year 2, year 3, year 4, right? So, pretend this is this is the current year, right? 2024, right? And add 10 years, right? So, yeah, so that's kind of my expectation. But as of now, based off of today's growth rate, based off of reality, I would say it is going to be anywhere between 2 years, $1 to $1.70, right? But they need that's obvious. Right now they're growing at, bankruptcy case. They're growing at 5%. That's not going to happen. They're going to return back to growth. And when I say return back to growth, I'm talking like maybe like, let's say like 40%, 50%. Like the revenues for Alignment is 50%. We're talking 45% growth rate. If they're doing a 45% growth rate at a 0.5%, then you could start to see the stock in 10 years going to $63. Now, again, if it's treated at a 2.5 revenue multiple, which I highly doubt that it's going to happen 10 years out when the company matures. But let's just assume right now, let's assume 45% growth rate, a 0.5% price to sales, and let's say a double dilution. We're talking 1,000, we're talking a billion shares. So we dilute by 500 million. Then we go 10 years from now, we can say, okay, if they're growing 45%, they double dilute us. The worst case scenario I'm expecting Clover in 10 years from now is anywhere between, if everything falls correctly, is anywhere between $18 to $19 to like $31, $32. That's pretty freaking good. Okay. It's not end phase like growth, right? Because again, this is an insurance company. If I'm labeling them as an insurance company and I'm double diluting them, like I'm taking the worst things ever and applying it to them. If they're a SaaS, then we'll add 2.5 when technically we should be adding 5 or 6. But let's add 2.5. Yeah, with a double dilution, we're talking anywhere between a $94 to $157 stock. Okay, that's with a double dilution, guys. We're not at a billion shares. But as of now, assuming the worst and assuming that they can grow like Alignment Healthcare, this is what I see in 10 years from now, right? So it's when you look at it from that perspective, just imagine people looking back at this video. It's like 2034. God, we're going to be so old. I hate the sad part about this is we're planning the future, but we don't understand that this here takes time. You grow some gray hairs here in places you wouldn't imagine. And yeah, it sucks, life is short. That's why I say enjoy the moment, right? But they're gonna look at this video and they're gonna be like, frick, why would, damn it, YouTube, right? Why didn't you recommend this? But again, that's just how it works. Okay, that's how it works. But that's all I have for you guys. I hope this will be helpful. Honestly, reverse split or not, I think we're pretty good in that. I mean, if it happens, it's great. More institutional investors can come in. A lot of companies like Citibank reverse split, but they might get out of this one. They might. They have some time. They have a lot of time. Okay, so we'll see what happens there. But overall, guys, that's all I have for you guys. Hopefully you guys enjoyed my, just TED Talk here, and have a wonderful weekend. And I'll see you on the next one.